everyone, and welcome to the Buck Stops here. I'm Catherine Murray. Well, as we know, we've certainly seen these markets be very volatile. A lot of concerns surrounding a Fed policy mistake, recession fears, inflation fears, and one of the more interesting areas perhaps in the market has been the energy sector. It's been one of the best performing areas of the entire market. But of course, this week we've seen a pullback. There's real concern about demand destruction. So let's get up to date in terms of what is going on within the energy sector in Canada, but also, of course, globally. And for that, we are joined by Eric Nuttall. He is a senior portfolio manager at Ninepoint and also a partner at Ninepoint Partners. Eric, great to see you. Thanks so much for joining us.
Very happy to be with you.
Eric, let's kind of take it from the top in terms of, what you think the market is interpreting with respect to the energy sector, because we really have seen, I think it's about a 10% pullback over the past week or so.
It's been vicious. This has been the worst pullback going back to COVID, March of 2020. We have names down 30 to 40% in the past month and a half. And the frustrating part is, as a fundamental guy, we're going to talk technicals later on, so help us then. But when I look at the fundamentals for oil, when I look at the fundamentals for these businesses have never generated more free cash flow than they are today. Oil is checked back from 120 to about 98 to $100 purely on recessionary worries. So that fear of demand destruction, the fear of what may be. But we look at what is now, and the market's extremely tight. When we look at previous recessions, if that's truly where we're heading into and look at the demand destruction possible, the supply losses dwarf those. And so even in a recession, what we see are inventories continuing to fall. They've been falling. If you account for the Strategic Petroleum Reserve releases that magically end right before the midterm election for the United States, if you account for those barrels, the global inventories has been continuing to fall, i.e. the market has remained undersupplied. So we've even under a worst case scenario, we look at some people whose work we respect, energy aspects. And even in a recession, they think that oil is going to bottom at about $80 or $90. So we look at, after the 30 to 40% pullback, we have names trading at 40, 50% free cash flow yields. They've committed to give at least half, if not 3/4 or 100% of that back to us. So it's been, frankly, I would just say it's been so frustrating the past month and a half where you've got names falling 8%, 9% in a day. And I pull up inventories, I pull up time spreads. We'll talk all about that later. And things remain very, very strong. So there's this disconnect between where we are today and where people are fearful of where we're heading. And I've got 3 young kids, so it feels to me like I'm having to talk them out of there being a monster living beneath their bed. I can use logic, I can use rationale,
Right.
But in this market now, in a fear-driven market, it's more degrossing, hedge fund degrossing, inflationary expectations, dollar. It's not really oil fundamentals, but ultimately fundamentals matter. Ultimately, fundamentals are what is going to dictate the movement of both oil and energy stocks.
So let's talk a little bit about the fundamentals, because one of the reasons why the price of oil, WTI, moved so high was because of the lack of supply, which we have seen the vilification, quite frankly, of the energy sector for the past 10 years, so lack of investment. And then also, of course, the Russia-Ukraine war, which, when you really talk to the experts, nobody thinks that's ending anytime soon, unfortunately. So, those are the two, I think, pillars, the key pillars for the fundamental thesis in terms of why you would continue to go long oil.
Yeah, we've been bullish on oil for a couple of years, and there's 4 major tenets to our multi-year bull market thesis. We think the market is structurally undersupplied. We think that undersupply will last for at least the next 5 to 6 years. And so it comes down to demand growth, tame demand growth. We're looking for, call it 1 million barrels per day per year going forward. But the real story that you just identified is on supply. It comes down to 3 major things. One is the end of U.S. shale hypergrowth, that era where U.S. shale was growing in excess of global demand growth. And so therefore there is a call on OPEC and a call on the global supermajors. The second major key reason to be bullish on oil from a supply perspective is OPEC. What we're seeing are most countries undersupplying, underproducing their quota. Their quota system ends in August, even though the deal is in place for the remainder of this year. And so we only see 2 countries having any excess capacity. That's the UAE and Saudi. And when we say capacity, we're talking a hair relative to 101, 102 million barrel per day market. So we see OPEC running out of spare capacity by the end of this year. That is a majorly bullish catalyst coming for the energy market that people are still asleep to, even though people like myself, even the Secretary General of OPEC, the Energy Minister from Saudi Arabia, everyone's shouting and ringing the alarm bells.
So, Eric, we were just talking about the fundamentals and the importance of the fundamentals and why that will continue to move WTI higher, even though we've seen a real pullback. You were talking about the third pillar. What would that be?
Yeah, so the third pillar revolves around the global super majors. The vilification of the energy sector up until recently, that is. The ESG movement, that divestment movement, has meant that these companies have not been able to invest in new projects, sufficient investment for 7 years now. And so with the absence of shale growth, or meaningful shale growth, with the exhaustion of OPEC's spare capacity, the baton is being passed to a group of companies that can no longer run with it. And so we see this structural mismatch between supply and demand growth going forward. And so that's the very reason why when we see a pullback in oil from 120 into the 90s, even if 90 is going to be the floor and we have to get past short-term concerns about a recession and whatnot, if that's our floor, when we look at the amount of free cash flow being generated by this sector, it's absolutely mind-boggling. And so as frustrating, as almost soul-sucking some of these past few days have been, that's what allows me to maintain my sanity. And that is, I know every single day, the free cash flow of these businesses is building day after day after day in the bank accounts. The deleveraging, we're almost there. And now the massive, meaningful returns of capital back to us as shareholders is coming, I think, in Q2 results and even more so with Q3 and Q4 results.
I want to go back to what you were talking about, though, with respect to OPEC and the inability for them to produce more or have more spare capacity that you say is underappreciated by the market. Can you tell us a little bit more about that? Because I'm not fully aware either, and I am a long energy investor.
Yeah, so we've all been conditioned to think that it takes 4 to 6 months to bring on a barrel of supply because that's been the major incremental source of supply from U.S. shale. You start drilling, 4 to 6 months later, you get a barrel of oil. The real story is the majority of oil production globally comes from what's called long cycle production. Why is it long cycle? Because it takes a long time to bring it on. So think about the big offshore projects. They take 4 to 6 years to bring on. And so we've seen the super majors stop investing post the last price crash. Investments are only back to half of peak levels. And when you have Saudi Aramco, which is regarded as the most sophisticated energy company on this planet, well, they're building capacity. They're building capacity by 1 million barrels per day. But they've said, look, it's going to take us 5 years. We're not going to be able to achieve that till 2027. And so they've been saying, look, we're telling energy policymakers all around the world, we're hurtling into a crisis, but you're not listening because we're doing our part. We're adding capacity, but it takes time. There's no way to circumvent that. So that's the reason why we say we're in a multi-year bull market for oil. It relates back to cycle time, how long it takes once OPEC and once the super majors are at a psyche where they're starting to meaningfully spend. You can start your stopwatch. You still have 4 to 6 years from that time point. And from recent meetings with the global super majors, they still aren't there yet. And so we really think there's longevity to this trade, and the market is completely asleep to how important the exhaustion of OPEC's spare capacity is going to be.
And Eric, when you say the super majors still aren't there, are you saying, 'cause this is what I'm kind of hearing in the news, and you see it in the headlines, and you see it with respect to policymakers still not buying into the fact that we actually still are very energy dependent on fossil fuel energy. We're not, we obviously can't make it on solar and wind at this point. But are you basically saying, though, that the CEOs of the super majors, many of them, still know that they're not producing what we actually need? They're not there.
I think they know that they need to get there, but the hindrance is guys like me, the shareholders, saying, look, we've just lived through the worst bear market in history. It's our time to get paid. And so you're not going to go and outspend your cash flow like you did before, leading to price crashes. What you're going to do is underspend. You're going to maximize free cash flow, and then you're going to pay me a really, really juicy dividend, and you're going to go buy back at least 10% of your stock every year until we get a re-rating in valuations. Like I'm buying as we speak now, I'm not going to say which one, but I'm buying a name trading at 1.1 times its annual cash flow at the current oil price. I shouldn't be able to do that. And so Should that company be growing production? Absolutely not. They should be buying back alongside me every single share in the public market that they can. And so generally speaking, globally, energy investors do not want growth. They want to be compensated for the agony that they've had to endure over the past 8-9 years.
At the same time, though, I mean, we know that globally we need more oil, and because we don't have as much, obviously the price is going higher, and then you've got inflation. Now it's like full circle. We've got concerns surrounding demand destruction. So, we need a bit of a sweet spot, I would think. But we're going to take a quick break, and when we come back, we'll get your response to that. We'll be right back. Eric, so I do want to bring the demand destruction point up, because I think that is the key reason why we've seen WTI pull back so significantly. How do you factor that into, buying energy stocks right now?
Yeah, if you look historically, the periods of negative demand growth are very, very rare. Usually it's a moderation in the rate of growth, meaning, you can absorb shale growth, which is going to be much more modest than people think. You can absorb any incremental barrels coming from OPEC. It's very, very unique time periods in history when demand growth goes negative. We've got to go back to COVID. We've got to go back to the financial crisis. And then before that, you've got to go back to the 1982, 83. And it usually relates to negative global GDP growth. Goldman Sachs just came out with a scenario analysis this week, and they said, look, let's put Europe in recession. Let's nail global GDP growth at half of that rate. And even then they have growth for oil growing. And so we think when people talk about recessions, what they're really talking about is a moderation in the rate of growth, not negative growth in and of itself. And as a reminder, I think that the supply challenges that the world faces will more than offset any decline in the rate of growth for oil. So that's the real story. It's not about demand. It's really about the supply challenges that we face.
Where do you think Canada fits into the equation these days in terms of the opportunity potentially, or not?
It's tricky. Like, we have legislation prevents any new pipelines beyond the TMX expansion, which would be early 2024. When Biden's traveling to Saudi Arabia with hat in hand begging for more oil, Canada, we never come up in the global conversation, and it confuses me. We produce the highest rated ESG barrel on this planet. We have an abundance of reserves. We're the best at oil extraction, and yet the administration never thought to come up here and ask for more oil from us. And so I think there's this weird tension between having to placate the progressives, so to speak, even though the world's hurtled into an energy supply crisis. So you've got to placate that group, but at the same time, there's the reality that we can't face what Europe is facing. We just had the largest landlord in Germany this morning say, so they have apartment buildings, and they're restricting the heating to 17 degrees Celsius because they have to conserve gas because they're going to run out of it in wintertime. That just came out this morning. And so my hope is what we're facing as a world is a teachable moment for energy policymakers to realize that you and I will be consuming hydrocarbons for the rest of our lifetimes. We need hydrocarbons as base load. And so let's be smart about it. Let's do it in an environmentally responsible manner, which we already do, but let's be honest with ourselves that we can't live off of solar, we can't live off of wind. We need hydrocarbons as base load.
Eric, because, as I look at the market, and as I said, in full disclosure, like I'm a big energy investor, and I'm not worried, I'm not panicking, I'm, staying long, and I am staying long as well. And I'm curious and interested to see what happens when we do hit winter and people need to heat their homes. So that's so interesting to me that you said that Germany's largest landowner is going to be restricting the temperature. People really need to think about that.
Yes, they do.
But my question is, did you see any? Did the market pick up on that? Was there any movement in the pricing?
Not yet. I think Europe at least recognizes that they're hurtling like at Mach 15 into a brick wall. I think we're a little ignorant still in North America, thinking that we have an abundance, therefore we're safe. But we are in an era of higher oil and higher natural gas prices going forward due to those structural challenges. whether it's created by investors like myself, whether it's created by policymakers by having made horrendously awful decisions over the past 5, 6, 7 or longer years. And so it's really the culmination of that. We're emerging from COVID. You've got this demand surge. We've been averaging $100 oil this year with China locked down for most of the year. And so they will one day come out of lockdown, and you're looking at an over 1 million barrel per day rebound from there. You referenced earlier, like we have challenges from Russia. They could turn off the Nord Stream 2 pipeline to Europe. Well, for a replacement, that's almost 1 million barrels per day of oil demand growth incrementally. Compare that to the demand destruction we saw in the 2009 recession, which was 800,000 barrels per day globally. So people are panicked about demand destruction. They're not talking about the supply challenges that I think you could pick 15 of them that can more than overwhelm any demand destruction that we see.
Right. And I think it's also important to point out, where's Russian oil going right now?
It's basically flat. It's unchanged. And so it's really going to be a 2023 story once the financial embargoes from Europe come into place. But right now we're seeing no impact.
Okay, we'll take a quick break. We'll be right back. Eric, I always love to give our viewers some stock ideas. Obviously, this is what you do all day long. And, people really need to understand it is a 24/7 job. But right now, what are a couple of names that you like, that you'd be putting money to work in?
Yeah. So the key theme I'm focused on now are companies that are maximizing free cash flow, moderating growth, and returning that excess free cash flow back to investors to drive the re-rating. I really think by doing so, given the pummeling that we've endured the past month and a half, I'm really hunting for multi-baggers now. Stocks can go up well in excess of 100%. So when I think about in Canada, like a Baytex, which has just been crucified, they are sitting on assets in the Clearwater play, which is the most economic play in North America. Literally, you spend like $1.5 million to drill a well, and that well is worth $5 million at $70 oil. So forget $100 oil where we're trading now. It's trading at about a 40% free cash flow yield, 1.5 times its cash flow, like enterprise-wide cash flow at $100 oil. They've committed to buybacks, which they're actively doing now. And so you can buy, there's no discernment in quality. You're paying essentially the same multiple. Like North America, the average company is trading at 2.1 times at $100 oil. So I like Baytex. Another name would be like a Tamarack Valley, similar thing. They've got their major focus on this play in the Clearwater. Stock's trading at 1.5 times, about a 35% free cash flow yield. And when I talk about free cash flow, like, what does that mean? They have all, and so as the largest investor in Canadian small and mid-cap companies, we have a seat at the table, not at the board level, but we have conversations with boards and such. And so our communication to them is once they get their balance sheet in check, we want at least 75% of that free cash flow, meaning we want buybacks and we want dividends. And so when I quote a 40% free cash flow yield, we're looking for 30% to come back to us. And so you're basically looking at 10% through a normal course issuer bid. I'm looking for another 10% through an SIB, so in excess of NCIB. So that basically, with the average Canadian company able to privatize now with 3 years of free cash flow, they're just generating so much. And so by companies being active in those buybacks, it can drive the re-rating. Like we're buying name, as I mentioned now, trading at 1.1 times cash flow. It's stupid. MEG is another one that we're maxed out at. I think we're one of the largest shareholders. It's a 10% weight. We're basically getting 32 years of free cash flow for free because they've got about 35 years of reserves. I'm paying for under 3 of those. So I get 32 years of about 34% free cash flow for free. And they've said once they get their balance sheet to where they want to be, which is about June of next year, 100% of that is going to come back to us. So think about that. Like in the marketplace today, using the current oil price, you can buy a company that has told you that they will basically privatize with 3 years of free cash flow, or they could pay you a 34% dividend and in less than a year from now. And they're already actively buying stock back now. So that's the common theme I'm focused on, whether it's a Baytex, a Tamarack, a MEG, an Enerplus, the same thing. I think you're going to see SIB, significant issuer bids, later this year because there is a massive disconnect between the reality that these companies are facing, which is record free cash flow, and the brutalization of their share prices over the past month and a half as people are panicking about, my God, if we're in a recession, what does it mean for oil and such? So it's to bridge that disconnect by these companies using their free cash flow, not debt, but the free cash flow, and saying, okay, you don't want our stock? Well, we will. And so if you're a dividend payer and you buy back 10% of your stock, that's basically like a 10% dividend bump the next year because you're retiring the amount of shares. And as an owner, I own more of the business going forward.
Yeah, you have a larger stake. The more that they basically take the shares out of the market. Eric, I want people to understand as well what the name of your fund, where they can find you, because I'm also a big believer. Like, I do pick a couple of stocks, but I also am a big believer, having been and worked on Wall Street, that it's great to have great money managers, and they're hard to find, and you got to do your homework and you got to find them. But talk to us a little bit about your fund. I've got like 40 seconds.
Yeah, so the Ninepoint Energy Fund was the best performing energy fund in the world 2 of the 3 past years. We're listed on the NEO exchange under NNRG and ETF. You can buy us a mutual fund version. We also have the Ninepoint Energy Income Fund, which launched 4 odd months ago. It's small. It's only about $150 million. But we think that these companies that we hold now are paying about an 8%, 8.5% dividend yield through variables. Plus, we are writing calls on them to generate additional yield. So if energy investors want the best fund in the world, at least through the past 3 years, to maximize upside, where we see very, very significant, well in excess of 100% upside going forward, we have that product for you. If you're looking to maximize yield on a monthly basis, we now have a product for you as well. So those are the 2 options.
Great. Eric, great to see you. Thank you very, very much. We'll speak to you soon.
Thanks so much.